Welcome back, everyone. Today we're throwing on our expert investment analyst hats to dissect one of the most, absolutely fascinating corporate pivots of the year. In this explainer, we're unpacking the dramatic shift we've just seen from MillerKnoll. Now, if you follow the industrial and consumer sectors, you already know MillerKnoll as an absolute heavyweight in furniture and home design. We're going to look at their fiscal 2026 results to figure out if this is a classic Peter Lynch turnaround play, because wow, the leap from stinging net losses straight back to solid profitability is something you've got to see.
Okay, let's dive into this. Here is our roadmap for today. Number 1, a dramatic financial turnaround. 2, a segment performance breakdown. 3, we'll look at the balance sheet and dividends. 4, looking ahead to 2027. And finally, number 5, valuation and some final thoughts.
All right, kicking things off with Section 1, a dramatic financial turnaround.
$1.004 billion. Yeah, that's with a B. That is the revenue MillerKnoll pulled in during Q4 alone, totally shattering that billion-dollar mark. This 4.4% year-over-year bump for the quarter helped push their full fiscal year 2026 net sales up 4.7% to a staggering $3.842 billion. To generate that kind of top-line growth right now, in a fairly challenging macro environment, it shows their core business still has a very strong pulse, which is literally the very first thing we look for when evaluating a potential turnaround stock.
Now, what's really interesting about this slide is the stark contrast. Over on the left, you can see the sheer pain of fiscal 2025. We're talking a net loss of $36.9 million, heavily plagued by special charges, impairments, margin struggles, the whole shebang. But look at the right side. Fast forward to fiscal 2026, and they've completely flipped the script, delivering a net income of $91.5 million. This proves their restructuring and cost management strategies aren't just empty corporate speak, right? They are translating directly into bottom-line profits.
And Wall Street definitely took notice. For Q4, analysts had forecasted an adjusted earnings per share of 52 cents, while MillerKnoll beat that, coming in at 55 cents. Looking at this through a Warren Buffett lens, this is exactly what we want to see. Management proving their quality by operating way more efficiently. Plus, that gross margin jumping to 39.4% for the quarter, that's a super strong indicator that their pricing power is returning.
Moving right along to Section 2, segment performance breakdown.
So where did this billion-dollar quarter actually come from? Well, the heavy lifting was done right here at home. The North America contract segment was the absolute hero here, posting a 6.9% increase in sales, primarily driven by strong leverage and pricing realization. Global retail also pulled its weight, growing by a solid 5.5%. But to be fair, it wasn't all perfect. The international segment actually saw a decline, struggling quite a bit with a tough regional sales mix and some messy currency impacts.
Let's zero in on that 5.5% global retail growth for a second, because this didn't just happen organically. It was directly fueled by an aggressive expansion strategy. Opening 15 brand new stores in fiscal 2026, mostly in North America, is a highly deliberate move. It builds brand equity and creates a much wider economic moat against competitors by capturing direct consumer spending.
But here is where we really need to put our analyst hats on, okay? Because the crucial takeaway here is this. While North American contract sales were up 6.9% in Q4, future orders in that exact same segment actually dropped by 10%. Why does this matter? Well, because orders represent future revenue. This decline is basically a flashing yellow light warning us of potential macroeconomic weakness ahead. It's a great reminder that even in a highly successful turnaround, vulnerabilities still remain.
All right. Let's transition to Section 3, balance sheet and dividends.
When evaluating a company's fundamental health, both Peter Lynch and Warren Buffett demand a strong balance sheet with highly manageable debt. MillerKnoll's net debt-to-EBITDA ratio sits at a very comfortable 2.80x. When you combine that with $571.7 million in total liquidity, they easily pass the balance sheet test. This gives them the financial flexibility to weather future storms and, more importantly, fund their own ongoing growth.
Now, if we apply Benjamin Graham's defensive investor checklist, one key requirement is a long, uninterrupted record of dividend payments, and MillerKnoll checks this box emphatically. I mean, we're talking about records going back to 1972, through stock splits in the 80s and 90s all the way to today. And this brilliantly illustrates their commitment. The recent board declaration of an 18.75-cent quarterly cash dividend is just proof of a multi-decade commitment to returning value directly into the pockets of shareholders.
Section 4. Looking ahead to 2027.
Management is projecting some serious confidence right now. Let's break it down. Step 1. They're targeting first quarter sales between $928 and $968 million. Step 2. For the full year, they expect sales to climb somewhere between $3.93 billion and $4.13 billion. And Step 3. This is big. They're expecting gross margins to approach 40%. For those of you out there building discounted cash flow models, this is the absolutely crucial metric. Expanding margins on $4 billion in sales translates to incredibly robust future free cash flows. And as we know, that is what ultimately drives intrinsic value.
Finally, Section 5. Valuation and final thoughts.
So, what does this all mean for the stock price? Let's look at what the broader community is saying. According to one community member estimate over on Simply Wall Street, MillerKnoll's fair value sits around $35 a share. If that projection is accurate, based on current pricing, that would represent a massive 67% upside. In value investing terms, a gap this wide between the current price and the intrinsic value provides a really substantial margin of safety, making the turnaround potential here highly attractive if they actually hit those 2027 targets.
Let's weigh the overall thesis here. On the tailwind side, this is a classic Peter Lynch turnaround playing out almost perfectly. You've got successful restructuring, expanding margins, and highly manageable debt. But on the risk side, we can't ignore that 10% drop in North American contract orders. It reminds us that macro uncertainty and potential tariff-related costs act as real anchors. It's totally a balancing act.
Which leaves us with the ultimate question. Can MillerKnoll actually maintain this incredible momentum amid all this ongoing macroeconomic uncertainty? Look, they've proven they can execute the turnaround. Now the real test is durability. You'll definitely want to keep a close eye on their free cash flow and order numbers next quarter to see if this value play is truly real. Anyway, thank you so much for joining me for this explainer. Stay curious, and I'll catch you next time.